Okay, welcome guys to the lesson number 3. This one is going to be on trends. Like a little recap here, zones, yeah? Firstly, the zone. Who was it? I think it was Warren Buffett or George Soros, one of the two. We consider them great, yeah? I do. They said that successful traders do nothing most of the time. And I think that should be the way we should be, all going. So we should be waiting all the time, like not do nothing, but, I don't know what you do while you're waiting, but we're waiting for prices to get to these zones here. That's what we need to do. This is what we need to be doing. And then also we need to be waiting on trends, because those are now also our zones. If we can identify the way it's moving up, the way prices are moving up, then this too becomes a zone. Now, the issue that we have with trading is that the zones or the trends are only a confirmed trend once we are very late into the game. So if prices are coming down here, and that becomes a zone for us to trade in, that was our first, our second, our third time. And then this year becomes another zone to trade in. But then it's so close to where we are going to take profits anyway. So our R is going to be on the negative side. Yeah. We are always trying to get 2:1 risk to reward at least. But when it gets this close, and then that idea becomes worse as we are moving up. So what do we do instead? This was what we did last week. Last week, we said, let's try and find the first opportunity to trade after you've identified a trend and then it breaks. Then we're looking for a pullback, and we're going to trade here as our first opportunity to go short. So as prices are moving down this way now, we are looking for our opportunities there. So this becomes our new zone. These becomes our zones now. So taking it here is like a late trade idea. Yeah. So I wouldn't be looking here for my first opportunity to target this area here on top. That's not the idea. The idea was taking your first opportunity as it hits the zone here at your support level. And then this was my downtrend, and there was a break and a pullback. And then this was my first opportunity after the break. So this was number 1 and number 2. But as it gets closer to the target, I'm not saying don't trade this. I'm saying trade it on a lower risk. If you usually risk 1%, then use maybe 0.25% as a risk here. Okay. Okay. So now that we have that behind us, we need to identify a trend. Now, a trend, in any of the textbooks, a trend is going to have at least 5 legs to the whole move up, to this impulse move up. Now, the reason it's going to have 5 moves or 5 legs is because we're going to need these 2 points at least to be able to draw a static trend line here. Because if you only have 1, 2, 3, and then you only have 1 point there. So there, in this case, you have 1 leg, 2 legs, and 3 legs. So you're going to need this pullback to create the next point. And now you have 2 points, and you can draw a trend line. However, this only becomes a confirmed trend according to the textbooks now when you have another leg going higher than that point there. So now this is a 5-legged trend reaching its target. Now it makes another pullback and another move up. So this is a valid move up toward the trend. Let me just explain that in another way. If you have a trend that's going up, or a move, an impulse move moving up that way, right? Now prices are right at the level here, but you only have that 1 point. Yeah, so which means there is no way of drawing the trend line here, a static trend line. So the trend here is not a valid trend according to any of the textbooks. Yeah, but because prices are at the level we are anxious to trade, I'm going to suggest to you to try and identify this move differently instead of with a static trend line. Perhaps you can use a moving average instead. Like our 36-period moving average becomes our dynamic trend line if we can't draw a decent static trend line or a valid static trend line. Again, I'm not going to say don't trade this if you can't draw a static trend line. I'm going to ask you to drop your risk in this case. Because nothing is going to suggest that this is not going to work out as an opportunity now after the break of whatever dynamic line you've got here. Yeah, it might break, and then that could be your next opportunity to go down. But lower your risk because you only have 1, 2, 3 legs instead of 1, 2, 3, 4, and 5. So it's at least 5 waves or legs up toward your zone is what we are looking for an ideal situation where you can then risk your full amount. Yeah. If you are a 1% trader, you risk 1%. Then when it gets to your zone and the trend line breaks, you risk your full amount. If the trend is not identified as a proper textbook trend, like you have only 3 waves, then lower your risk, 0.25 or whatever. So according to Elliott wave, you need at least 5 waves to have a proper impulse move up, yeah, or 5 waves to move down. That's Elliott. Now, Elliott, he defines the trend even more now, yeah. He says that the second wave here, as prices are moving up, the second wave coming down shouldn't move below the start of this first wave. Yeah. So prices are moving up. Prices are moving up from there and it comes down. So that's still valid if it moves up from there, past that point there. But if it comes down like it does here, past the 0 point there, then this becomes a non-trend. It's not a valid trend line. So as you can see here, it's not easy to draw your static line here. So which means when you get to your zone and you're trying to find the break, then you lower your risk in this case, because this doesn't have your 5-legged move toward the zone to validate this as a trade that you will take on a full risk. It doesn't have that. So this is one of Elliott's rules. So we have to define the trend in an objective manner so that we can know when to take a full risk and when to take a half risk or a quarter risk. Yeah. Now, all of this needs to be identified in the very last lesson when you do your trading plan for us. Yeah. Like, what is going to be your risk, your normal risk, if everything is lining up? Yeah, you have all your ducks lining up. You have your 5 legs and you have everything. See, difficult to draw your 2 points when that happens. Another rule with Elliott wave is, as prices are moving up, this 4th wave down shouldn't breach the territory of number 2. Because here you can again see that you can't really draw a decent trend line here. So lower your risk when prices gets to the zone. You see, can't draw this 2 points. So what I'm saying or suggesting is that no matter how many waves you have, if you have 1, 2, 3, 4, 5, and then it goes, it's qualified here, right? And now it's going up. This is all valid as long as you have at least the 5 waves toward that move. Then you can trade your normal risk at the zone. Because the 5 points, 5 waves, you don't have 5 waves, so you can't draw your static trend line again. And then again here, if you can't identify a proper static trend line, then you can use the EMAs that we've suggested, like the 36 and the 12. If you using the 12 period moving average, for instance, let's say this year, now prices are coming close to the 12 period moving average, and that becomes now your dynamic trend line, 12 exponential moving average. Yeah, so now you've identified this is not a proper trend, but there is a volatile trend. Now volatile means that it's only able to pull back toward the 12 period moving average. Yeah, should be doing it on top here, sorry, going up like that, only pulling back toward the 12. Or the 36 period, which is our usual trend following EMA. Just identify the move up toward the zone. If it's valid, like it has its proper 5 waves and it adheres to all the rules of Elliott wave, then you use your full risk here. If not, you lower the risk. If the trend is not identified properly, then lower the risk. Waiting for that break, pull back, and then continuing down. Some more rules with Elliott wave. Yeah, it's very important to get the idea of what a trend is, and that you can objectify what a trend is, because that is going to determine what you're going to do at these levels on top here. Yeah, it's very, very important. So the wave 3 here is often the longest of the waves in Elliott wave. The only thing is that the 3rd wave should never be the shortest. Now, these ones going up like this with the trend, yeah, that's what I'm talking about, the impulse wave, not the correction here. The impulse ones are in red and the corrections are in black. So the third wave is often the longest wave. Yeah. However, it can be shorter than one of the two, but never shorter than both. It can't be the shortest of them. Then this is not a proper trend, which means when it gets here, you lower your risk. If you are taking the idea to go short, you're looking for a trend line break. So the third wave can be shorter than one of these impulse waves here, but it can never be the shortest. So this one is fine because it is longer than this fifth wave, which is the shortest of them. So that is fine. If you notice also, it's more difficult to draw a static line. This is the one where the trend line is the shortest. The middle one is the shortest. So now it becomes more difficult to draw the trend line, you see, coming up like that. More difficult. You must wait for a long time to break that trend line there. Yeah. So which means when it gets here, you lower the risk. Right, so now we know what a trend is, how to objectify a trend. Yeah, it's a five-legged move up, and there we have waves going up, and if one of the waves breaks the start of the first one, then it becomes nullified. Then we have to identify the trend in a different manner. Yeah. Like if we're having a look at the charts here now, we can see that this trend here looks like it's okay. But if we draw a static line, then it's going to be running across here. So in this case, we can use our 36 EMA as a dynamic line. So waiting for the break of that, but then lowering your risk because you can't draw a decent trend line. Whereas with this one here, you can actually draw the trend much better. You know, you can draw a static line because you have your waves going 1, 2, 3, 4, and then 5, and then 6, and then more waves there, at least 5 waves. And then the break of your dynamic line and your static line. So now in this case, when it comes back, that is a valid area to trade your normal risk. But in this case, in the next case, you have 1, 2, 3, and you don't have everything. So you lower the risk if you want to break a dynamic trend line here. In this case, is your 36. So it breaks your 36 there. And then on this idea, you would lower your risk. So if you can't draw a line, you can use the 36 EMA or the 12 EMA. 36 is your normal trend line, and 12 is like a volatile trend line. Prices are not able to, when it retraces, and it's only able to get to the 12. It's the sellers in this case are very much in control there, as it's hovering on the 12 period moving average. Okay, for these, I'm going to go on a blank sheet for these. Yeah. Let me do it in. Glenn, if you are ready, what comes after number 5? If it gets to your zone and you're at 7 or anything more than 5, then you can start looking. As long as we have 5 waves moving up, because without the 5 waves, we can't draw a static trend line. That means you need to lower the risk at the level, because we are looking for a trend line to break. So, and a trend line break doesn't mean anything if the trend isn't a justified or a legal trend. Like if we're looking at this areas here now, this is a trend going up. It has at least 5 waves, which means you can draw a static line here. You can draw a static line there as a trend line. Yeah. And you have double confirmation that the 36 is your trend line as well. So you have a break of the trend line. Then that becomes your first opportunity after the break. That there becomes your second opportunity after the break. And then that there's your third opportunity. That there's the fourth, fifth, sixth. And then here, in this case, you have a trend line that breaks again. And then that becomes your first. And then that becomes your second. And then that becomes your third. The lowest low. Perhaps I'm going to look at the questions afterwards, because it might be answered during the lesson here. Okay, so trend line analysis is firstly identifying whether it is a trend or not. And we use Elliott wave to help us define whether it is a trend or not. And once we've identified that it is a trend, then we're looking for weakness in this trend. So this is a trend coming down. Yeah. So we need to find weakness so that we can have an idea of when to start looking for this break. When to start looking for this. Yeah. That's what we're going to do next, after we've identified that this is a valid trend coming down. So we have a few ways of identifying weakness in the trend. The one is using momentum, and that's based on Dow theory. The momentum of the trend is losing strength. Then we're looking for a break of a trend. Because as Glenn said, we don't know how many legs this trend is going to have down. The only thing we know is when we have 5, it's possible to draw a line. But it can go down all the time till forever. Yeah. But at least 5 means that this is a valid trend. And now we can draw a static trend line, which makes this whole thing valid. Yeah, if there's 12 or 11, 13. But what we are trying to do here is, once we've identified that it is a trend, where there might be weakness. So we are doing analysis of the trend line, trying to find weakness. And we're going to use Dow theory now to help us identify where we could get a possible break of a trend line. Okay. Now, possible break of a trend line could be identified when the EMAs are becoming closer together and it looks as if it's going to cross. So we have a 36 EMA here, a trend following EMA, and the 12 period moving average. And then it's coming closer together, the two lines. As it's flared apart here, it's more likely in a trend. And as it's getting closer toward each other, there's a possibility of a range or a possibility of a complete trend change. Now, in this case, it gets closer, and then we could identify that there's a break. So we don't do anything because of a cross, but we do look at what's happening as it is crossing. Are we getting the break and the close above the trend line? So the first clue for weakness, we could use the EMAs. And then there's another clue, the one that we are all used to already. We are looking at the RSI. So when you get a divergence on the RSI, then that could be a clue that the existing trend here is becoming weaker. And when the trend is getting weaker, this is when you want to start looking at a potential break of that trend line. Also, remember that we were trading based on the zones in the first place. So in this area, there was a zone that we've identified already on the daily chart. Yeah, we've identified the zone. There was touches here. So the zone was very important to us. So the possibility for looking for a trend line break just because of that zone is also there. Now, adding confluence to that was the RSI here, and adding some more confluence that we might look for a break of this trend line is the cross of that EMA, or it's moving closer to each other. And then the other thing is that you were looking for the weakness, and then it actually broke and closed above the trend line. But you've taken your first trade already here based on the zone. Yeah, on the lower time frame. That was trade number 1. You're looking for number 2 now. And number 3 as it's going to your next zone. As prices moves up toward that zone, you're looking for weakness of this trend. But you've taken your 15-minute trade here already based on the entry methods. 1 of 6. Now you're looking for weakness of this trend, because if there is no weakness and it carries on, then that trade was a loser. You're waiting for the next one, the next level. Looking for weakness here again, looking for entries, looking for the break and the continuation down. So weakness of a trend. So there is no use looking for a non-trend. If this is my zone here and it moves up 1, 2, 3, that's not a trend that's identified, because there's only one touch there and there's only 3 legs. But if you have identified this move here as a volatile trend, perhaps trending on the 12 period, you know your 15-minute trade now needs lower risk. Yeah, because now the possibility of it just continuing is higher. So this is why you'll be lowering our risk in this area. But if we had a valid trend moving up to there, then we can start looking at trading our full risk here. Yeah. Probability that it can break is higher than this one. Yeah. Over time and during testing, this is what you will notice. This sort of a trend, and your next 10 trades might work out like this, but over a series of hundreds of trades, that works out better than this. So you're finding weakness in a valid trend toward the zone. That's what we're doing with the trend line analysis. So far what we have is we've identified weakness of a trend as it approached the zone. We could use the RSI as an example of a weakening trend, and we can also use the moving averages. But we can also use this momentum style of analysis to find weakness. So that's measuring the waves of each of this, the waves of each of the trends, the moves down, the impulse moves down. So in this case here, we have our first move down, and that was worth 520 pips. And the next one was 680, which means if your first move down here, say for instance, it breaks that. Yeah, we've identified that, and that's a perfect looking trend. Yeah, so now you broke that trend down. That's wave number one. You've taken a trade idea there on the 15-minute already. That was your first entry. Your target was all the way down here. Yeah. Then that was trade number one. Now you're looking to add to your position, and you're feeling more confident now because a valid trend line is broken. Yeah. A valid line is broken. So you're feeling great. Now you want to add to your idea. So trend line breaks. And that first move was 520 pips. Yeah. And then there was a move up, a correction. Okay. And that was this is your second trade idea, but it's your first one after the trend line break. Yeah. Now this move down was worth 680 pips in this case, right? So then you have another correction going up. Now, because the second wave down here was longer than the first one, you can take the next one. Validly, you can feel comfortable that is going to be fine. Then prices goes all the way down, and this was 780 pips. Yeah. Prices comes down, this wave is nice and strong. Then you come all the way up there, another correction. Now this wave here was shorter. This wave here is shorter than the previous wave, which means now the next pullback, that one, you don't feel comfortable taking the trade short because the waves were getting shorter, your previous wave. Yeah, this wave, impulse wave coming down, this one is shorter than that one. So the next pullback up, you will be uncomfortable taking because the waves are getting shorter. In this case here, the 520 pip wave, and then your second wave came down at 680 pips. So which means this one is a decent one to go short on. Yeah. That's one reason to take these following the trend, and not to take that one following the trend down. But we are looking for weakness in an existing trend line. So the trend here is becoming weaker based on the momentum of these impulse waves down. You've identified the trend going down. So you have one impulse wave, you have a correction, another impulse wave, correction, another impulse wave, correction. Yeah. So all these impulse waves is what we are measuring here. If they are getting shorter, then you can identify this trend as becoming weaker, which means you can look for a trend line break now. trend breaks. So we have moving averages as a signal of trend line weakness. You have the RSI, you have your zone as a possible weakness, and you also have this momentum of the trend. The legs are becoming shorter, a sign of possible weakness. Doesn't mean it's going to get weak. It could go all the way down and even a stronger wave down. Just be alert when you see any sort of weakness in the trend based on all of these here. And then that momentum-based trend line stuff is all based on Dow theory. And then Dow comes with another method of trying to identify a weakness of a trend. Now, the reason we want the weakness is because we are interested in this break, because we want to be one of the first people in the next version of the trend going up to that level there. Yeah, we don't want it late. We don't want to trade that pullback there to target this. We want the first break of the trend so that we can be one of the first guys in targeting the bottom here. Yeah, this is the reason why we're looking for weakness of a trend. If you can validate that trend, then the trade becomes more, you can risk your full value there. That's what I do. I risk my full value if I can identify a proper trend. If it's not a decent trend, I have to validate it in some other way, like a dynamic trend line, then I will lower my risk there. Right, let's go over the last section of Dow theory on trends, weaknesses of trends. So Dow here says if the waves are getting shorter, the possibility of the trend line breaking is there. Yeah, the trend line. The other method here is the way it pulls back, the way prices are pulling back. So you have an impulse wave going up. So you have a Fibonacci level. Yeah, prices has gone up to this high point here. And then in this case, it's pulled back to around about 50%. So what do we have? We have an impulse move going up, and then we have a pullback. And then there, it's 50%. It pulls back to 50% before carrying on again. Yeah, that's what we have here. It pulls back to around 50% before it starts carrying back on again. And then the next wave, this was the first wave. It moved all the way up and comes back down to 50% of this move up. Yeah. Then we had our second wave here. It's gone up. And the sellers in this case was able to pull back to retrace to 61% this time. The first move up, they were able to push back to 50%. The second wave up, the sellers, were now able to push back 61%. And then there's another leg going up here now. Yeah, there's another leg going up there, and they are going to push back to, let's see, they are pulling back 78.6. So each and every leg here, the retracement, the correction, the sellers are becoming stronger and stronger. So in this up move, the sellers are able to push back a much stronger retracement all the time. There they pushed back to 78.6, and then they pushed then the buyers were even showing weakness by not being able to even get to the higher than that. So a clear identification here that this trend line is becoming, or this trend is becoming weaker, and that we could look for potential break. Yeah, there's our trend line break, and then that is our first opportunity after the trend line break. So previously, I asked you just to draw the line on the daily like this and look for the first trend line break. Yeah. Now for the homework next time, I want you to identify possible areas where the trend might be getting weaker, and then also show me the break. If we look at this example here, coming down, that there's a trend coming down. In this case, we have the EMAs getting closer to each other, and then that identified a possible trend line break here. So that's another one. Whether this is valid or not, it doesn't matter. Yeah, when it matters is that you're going to lower your risk on this trade now. These opportunities are all lower risk because this trend wasn't a proper trend. Yeah. But the homework section is you've identified this year your EMA is getting closer to each other as a reason for looking for weakness of this trend in the first place. Always in the zone anyway. So you will always have the reason for looking for weakness. The first one is that is a zone. The first reason is because there's a zone. The second reason is because the EMAs are getting closer to each other. And therefore, you came to the chart anticipating a possible break of a trend line so that you can then add to your next positions, targeting your next level. Then you get your trend line break, and then this is the homework. You have identified your zones, preferably on the weekly. Prices comes down on the daily, and then you're looking for your reasons why you are looking for weakness of a trend line. You can also tell me in the homework that it is a valid trend or not, and that you will take full risk at these levels or not. What I do in my strategy is that I'll take trade number 1 here, then look for, and if it's a valid trend line, I'll take my full risk there. That's what I do. And that's my first break pullback, and then I'll take less of a risk as it's getting closer to the next break pullback. This is my second break pullback. I'll take less risk here because we are so close to that. I'm already anticipating the break of the trend line so that I can go back down. Yeah, let's go to a chart there and see if we can show some examples there. Here we have the pound versus the dollar. Yeah, we have a trend line coming down here. Yeah, do you all see the chart still? Yeah. So you have a zone identified, and you have a trend coming down. You have 1, 2, 3, 4. So we're already at a stage where we can call this a valid trend line, right? And why should I come looking for weakness here? Because we are close to the zone. That's the first reason. Second reason, I don't have a good enough reason for saying that for using the moving averages, because the moving averages are still spread apart, and as they are spread apart, we are, the trend is still going down. So I can't use that as my reason. But what can I use here? I can use momentum. I can say that my first leg, I've got that first leg down. And then if I pick that leg up, I see my impulse waves are becoming shorter. So this is the length of my impulse wave now, shorter than the first. And then I move down to this one and see, okay, this waves are getting shorter as it's approaching this. So what can I do now? Now I can draw my trend line here and say, look, if I'm going to take a trade here as my first opportunity, then what I'm waiting for is, because I'm anticipating this, is that I'm waiting for the break of the trend line, and I'm waiting to get back into the market on my second opportunity, trying to get back up to this. And it all depends on how this looks. This is valid, so it means that I will take my full risk when I get here. If this was not valid, I will drop my risk on all of the whole trade idea as it's moving up toward the next part here. Not going to add to my long position here if that doesn't happen. Yeah. If this doesn't happen, then I'm not taking another position there. And let's say it's moving all the way up and it gets to my level here. Then the trade that I've taken here based on my zone is going to be on a lower risk, because there's only 3 legs up here. Yeah, it's just to identify for us what we will do, because when you're sitting and waiting and something happens, something that you've anticipated and it happens, then you just feel more confident and you feel better taking the full risk. And also, if the exact thing doesn't happen, the thing you've identified doesn't happen, then, and you take lower risk, you feel okay about that loss. You feel, oh, look, I've identified this as a trend that isn't really valid, because I'm using a static line instead of or I'm using a dynamic line instead of a static line. So in that case, I've adjusted my risk. I've anticipated I might not have a winner here. And then you just feel better in continuing doing the same thing day in and day out, so that you can gather the necessary statistics, so that you can adjust your strategy as it goes along. Yeah. But if you don't know what you are going to do when it gets to the zone, then that's going to cause strategy hopping, because it's not working, whatever. In this case, you've identified the possible reasons why it didn't work. It's because the trend wasn't doing the thing that you said it's going to do, or you've known that the ego is not going to be as bruised as it usually gets. Yeah, you were right. You've identified the trend weakness. Yeah, so that's the reason for trying to identify and objectifying the trends. And who better to identify trends than Elliott and Dow? Yeah, I think they were great at doing that. Yeah. Okay, let's see. So in this case here, and then also if prices are coming down, you might want to look and see if there's any other reasons why you might want to draw this trend line break here. You could go down or not go down. You could insert a RSI, because you want more and more reasons for you want more and more reasons to actually take this trend. So what we have here now is a possible RSI divergence as well. So anything more, so that when it gets here, you can really act instead of becoming paralyzed here. And it's not you're not over analyzing. It's simple. Do you see 5 waves? Yes or no? If you do, that's my risk. You know your risk already. Yeah, it's a very nice way of finding out what you will do when it gets to your identified zones. Try and find confluence wherever you can here. Okay, guys, I think I covered everything where trends are concerned. Now, if I didn't cover something, then can you ask me 355 questions, please? Because I need to cover everything here. This is the last lesson I'm going to do on trends. Azim says he feels that it's coming together. Yes, excellent. Yeah, it's the big, I promise you, Elliott wave is very, very complicated. And it doesn't need to be, because we don't need the full Elliott wave. All we need to do is identify whether his rules are applied in a trend, because we are looking for that trend change for our next opportunity. And it's going to identify and let us know how much we are going to risk or not. No, you'd find trades all the time. Here in this case, you will definitely find a trade. This is happening now. Yeah, there is a thing. Let's look at any other charts here and see what's going on. Say, for instance, you've identified this, for example, like here, you've identified these 2 zones, right? So now you have 1, 2, 3 moves up. So now in this area, yeah, you'd say, look, I'm going to take the trade short. It's only 3 moves up, but I'm going to take a trade short here. So I'll take it on 0.5% instead of my full risk, because I don't identify I don't identify at least 5 moves up. That's my reason for going for that. So now so what can you then identify? If you can't draw a proper static trend line here, what can you do? Yeah. So what you do is okay, let me just see, that's my area there. Then on the 4 hourly, we know that as it's getting up there now, it wasn't a proper trend. So we're going to identify this as a, volatile trend. Prices are just coming back all the way to my 12 period moving average. So what do I need to have broken here now? I need my 12 period nicely broken. So here it failed, and then here it worked all the way down to that target there. Let me see. So that is like a line that I've identified, knowing now that it's not valid based on the daily. Yeah, it hasn't really gone properly. So now you're looking for this trend line to break, and then you're looking for that as your next opportunity there. But you halved your risk because it didn't have 5 waves. Or you didn't take that one because you said you don't want to. What if you just don't take it? Yeah, then you don't take it. If you want to stick to that set of rules as strictly as possible, then do that. The idea is to objectify the thing that you are doing so that you know what you are doing wrong, so that you know what you want to improve on. You're not going to know, yeah, how it performs if you don't take these trades. Azim, now in the beginning of doing this, you might love the 3-wave move up. And if you're not going to take that, you're never going to know. This is why I say, take them and drop the risk. Next time, in a month, you will say, Rustam, that 3-wave moves doesn't work for me. I am not going to take it. But then you know exactly what it is that you're not going to take. You know what you're going to leave. And that is so important. Otherwise, you will sit and wait at the charts for something you don't know what you are waiting for. You are waiting, based on that last comment, you are waiting on a 5-wave move up and you're waiting for the break. You don't want the 3-wave move up. Let me see if I think the results are. Yeah. During the homework, then I will be able to see. Try and do the homework before the end of the week, guys, so that we can continue on, maybe even on Friday, with the entries lesson. Because the trend line breaks you've already done now. You've identified a trend line, and you've identified that you know how to find that. All I want now is for you to identify a trend and show me when you want to draw this line here. When would you want to draw and show me that weakness? Number one is you would want to show me the weakness because it's got to this level here. Yeah, you found this level. That's the reason you were looking for to draw this one in the first place. And then you told me that, oh, you was an RSI divergence, and that is why you were really keen on drawing the line to show me a trend line break. And that this weakness is just so that you are anticipating that break now, and you're adding confluence to the reason for wanting to come to the charts now. I don't like when we are sitting at the charts like all day long. I want you to know when to come. Yeah, Mark and I, we have Dr. Mark, yeah, Myrtle. We come to the charts when at certain times only, yeah, because we like the 4-hourly break. So we come to the chart every 4 hours only. We do the thing on a Sunday, and we do the daily thing. And you guys are included mostly on the daily room thing now. And then every 4 hours after that. And in between, we're not there, man. We're not there. Because otherwise we're not allowing our trades to play. Yeah, we're closing it too early. The best profits that I've made is when I wasn't here. When I'm not sitting at home looking at the chart, being able to mess up the trade idea, not allowing it to play out. Because there's stop hunts in between this on my new time frames. There's stop hunts all the time. Yeah. So, and that's going to cause that you want to come back to the chart all the time. So this thing is just trying to identify when you would want to come. You want to come to the chart when you are at a zone. When you're seeing the trend line is becoming weak, that's when you want to come, because you want to notice that break. I come every 4 hours. Yeah, I watch what's going on. For me, it's 3 o'clock, 7 o'clock, and 11 o'clock, and then that's it, man. And that's all you need. And I don't know of a successful trader who sits at the chart all day long. You guys probably have to do that now, because you need that chart time to notice all these things and see how it breaks. But afterwards, you will see, you with your plan, you will see that you're going to need to have specific work hours. We call it a business, but how can we sit there? No businessman is sitting there with his office open all day long, with him there all day long. Yeah. Have a specific time, and if you've missed the trade based on a time that you weren't available, then just adjust your plan and say, look, I'm missing trades at 3 o'clock here. I need to be there 3 o'clock. This is the way you need to build your plan. Let me just, yes, Dave, I am recording it. Do you, yeah. So trend line weakness, very important, so that you can identify that second opportunity. Yeah. Our first opportunity is always going to be the top there, because we want to, we're always trying to get into the trade earlier. So if we've identified that there are 5 waves, then the probability of this first trade working out is higher. But if you see a 3-wave move, then we always anticipating the possibility of this only being this first trade is only a correction, because it still needs another wave up. That's the reason why that trade there is lower risk, because you are anticipating a correction only, and it needs another wave further up to your next level, where you now do have your 5 waves, and then you're trading it there. Now, this year is maybe an ugly looking one. Then you can say that instead of looking at a static line, what is price doing? And in this case, it's doing its thing on the 12 moving average, which means then I can look at a dynamic line that has broken. In this case, is a 12 period moving average. It's broken there. And then looking on the lower time frame for that pullback before going back into the market there. But because you couldn't draw a static line, I lower my risk. If you don't want any of these, then first do it like this, so that you can identify the things that you don't want to do. Yeah, I hope I'm now not missing anything. Those are the ways I identify trend line weakness. Homework, identify other than the zone. We're going to take that as a given. Other than the zone, use RSI to show weakness. Use momentum of the waves to show weakness. Use the Fibonacci tool, the pullback to show weakness, and also use the moving average. You can use those 4 ways of identifying possible weakness in a trend as homework. So the same that you've done on trend line breaks and pullback, now just tell me the reason I've come to the chart here is because of one of those 4 reasons. The reason I've come to the chart to draw the line, to draw my trend line, and then anticipating a break, is because of those 4 reasons. Yeah? Then we can do the entries, because on every time you see an area like this, it's a zone. And that zone is telling me that I want to look for one of 6 entries to get into the market. Yeah. And that's it. So I don't see any more questions here. I think we are okay. Andy says, London Open, yeah, I like London Open. I love London Open. Don't like the Asian Open. It's because I'm too tired then. It's not because there's no trades then, yeah. It's because I'm tired then. Even though I come to the chart only 3 hours, whatever, every 3 hours, I don't feel like looking at the chart that late for me. Yeah, so yeah, I'll see you guys in the next one. So for homework, try and do it before Friday so that we can do that lesson on the entries on Friday. Right, guys? Thanks very much for joining on this one.